Happy Friday. I have a ton of information to cover for you guys today, so I'm gonna get right into it. As always, I'm not a professional investor. I don't work in the finance industry. This is an opinion channel about money. And I want to start off by saying congratulations to all my American subscribers, because last week when Charles Schwab released their announcement saying that they were going to reduce fees to next to nothing. Basically, it allowed all of you all over America to be able to trade stocks for free, which is amazing. And especially for options. I mean, tons of the companies now are going zero flat fee and then paying 65 cents a contract. Now, I've had a bunch of questions from people, so I'm gonna cover some things specifically on option trades. 2 weeks ago on the video that I did was setting up an iron condor on the SPY. So the very first thing we're gonna do is look at that. Now, originally on this contract, I got into it for $1.19. I can't remember, it was trading a little bit higher than that, about $1.38 when I did the video an hour or two later. Now, the reason for that was because we had seen volatility increase. So we're gonna talk about that today because I think it's a really important part of option trading. You can see a watch list that I have here and some of the positions that I have open. Now, the SPY today is trading at 297.78. Now, if you guys are interested in following the trades, you just have to check out my Patreon. I post trades like this periodically for free. Otherwise, I have paid memberships where people can follow my trades that I do. But in this particular one, if we go back a little bit, when I opened it, it was September 27th, and the SPY was trading at 296.75. So 296.75, and you can see that right now it's trading at 297.77. So we've had a $1 difference in that time frame. We can also see that the stock went down. It went down into the 280s and then it came back up. And this is exactly why I don't try to time the market. I play neutral strategies so that I can make money when the stock market goes down or it goes up, because we can't predict the future. Looking back, it was September 27th. It was right around here, and there was a bit of volatility that day on the 27th. We actually saw this drop. And what that did was it increased the IV rank. Now today, the IV rank is 22. And that's about where it was when I actually sold the original position. But a couple hours later, when we saw this drop, this volatility ranking went up, and it went up to about 30. And that is a really important thing for option trading, because when the volatility increases, the option premium value increases. And as a premium seller, I want to collect as much premium as possible. So I probably should not have been entering a position that was at 22. I usually try to put in positions at 30 or above. And I wasn't really expecting that move that day. So I just put in my position because I always roll SPY positions. I tend to frequently have a SPY position on, and I just roll either a strangle or an iron condor. And so 2 weeks ago, it was an iron condor. So originally the trade that I put on was this little guy right here. Sold the 287 put, so that's the low strike price, and we sold the 305 call. So we wanted it to stay above 287, and we wanted it to stay below 305 for maximum profit. And it was a short trade. It was going to expire October 18th, which is next Friday. So as you can see, the stock has done exactly that. It's $10 above the 287, and it's $6 below the 305 mark. I also put on the protective wings. I put on positions, a 279 put, which I bought, and I put on a 310 call, which I bought as well. And what that does is it limits my maximum loss on the downside, and it limits my maximum loss on the upside, both of them. So it's a really good trade for beginner traders. Now, it's not typically a trade that I put on, and I'm going to show you why, because I've been running a bunch of numbers because of you guys, because you all of a sudden have these incredible fees. This little chart I built, and it's pretty complex. I'm not going to bore you with it today, but basically it's got 4 columns. The first column is selling a single option. So it's either a sold call or a sold put. The second column, this gray column, is selling 2 options. So this is where we would sell like a strangle. We would sell a put down below and sell a call up above, setting our lower limit and our upper limit. And selling a 3 option play which is something I typically don't do, which would be selling the low put, selling the high call, so you've set your range, and then putting protection on one side. So either buying a put down below or buying a call even higher than your sold call. This will add protection. The reason I wouldn't normally do a 3 option position play is because if I am looking to do protection, it's probably to reduce my buying power. So I would put on protection on both sides. So I would limit my risk on the downside and I would limit my risk on the upside. When I do that, that becomes a 4 position play. So that would be this 4th column, which is 4 options. So you're selling the call, which is the upper limit. We're selling the put, which is our lower limit. That's the strategy that actually we're hoping will make us money, is selling those 2 premiums. Then we're buying the put down below and we're buying the call up above. So it's 4 different positions, and that creates either an iron condor or a butterfly, or however you set it up. There's a whole bunch of different ways you can set it up depending on how tight to the strikes you go. But today I want to just walk through what this chart represents, because these are kind of the fees that we pay in Canada and how ridiculous it is. So there's 2 ways you can look at options, and I know a lot of people down in the States follow Tasty Trade. Amazing free content on option trading. If you guys aren't familiar with them, you should definitely check them out. Tasty Trade, all about option selling, and they definitely talk a lot about buying back your positions at 50% of the maximum profit. Now, this chart is going to show you why it's so difficult for Canadians to do. So I've taken 2 different companies. So this first one, this top portion is Virtual Brokers, and then this bottom portion is TD Direct Invest. If I sell only 1 contract and I hold to expiration, the fees involved in this, the base rate is per leg. So I pay $6.49 for the sold call and I pay $6.49 for the sold put. And then the cost per option is $1 a contract. So that's how the math works out here. For example, if I sold a single contract in this first column, so selling 1 put, it would be $7.49, the base rate of $6.49 plus $1 for 1 contract. If I sold 2 contracts, then it would be $6.49 plus 2 contracts at $1 each would be $8.49. So you kind of see how that fee structure works. So if the option was selling for 40 cents, the gross income would be $40. My fee would be $7.49. My total income potentially maximum would be $32. It means the fees that I'm paying are $23%. And one of my personal rules is keep your fees as low as possible. So this is why, as Canadians, we get pretty hosed. If this was your strategy, if you were selling, say, puts, if you thought the stock was going to go up, you're selling put options. The number of contracts, obviously, because of this pricing structure at $6.49 plus $1 a contract, the fees go up slowly, so the fee percentage goes down a little bit. But selling 10 naked contracts in one directional trade is a big play. If you made a trade on the SPY, 10 contracts of SPY at $298 would be like a $300,000 play. So that's a lot of money to be playing with, and just to reduce your fee down to 4%. So typically the 2 columns that I live in are kind of this gray column here, column 2, where I'm selling the put and I'm selling a call, or I'm selling the put and I'm selling the call, and then I'm buying these protective wings. And you can see we just get hosed. If I'm collecting $1.06 on an iron condor, my gross income's $106 on a single contract. The fee is $29. And the total income is $76. 39% went to the brokerage, and I only got $76 from a $106 trade. And that's if everything goes perfectly, which they don't always. Sometimes you don't quite make the full profit. And then if you're following Tasty Trade, what you would want to do is close out early. So you would open with a little bit more duration, and when you get halfway through, say 21 days to expiration, you would close that trade. And if that was the case, if we're managing at 50%, that's kind of the next portion of this chart. What happens if I close at 50%? My fees are double. So what is the percentage? Well, like on this iron condor, 130% of the total profit is actually going to the brokerage. So the fee is $59 to make a potential profit of $46 from a $106 trade. It's like just asinine that they charge us so much. in order to bring these fees down to a reasonable level, it's almost impossible. Like selling 10 contracts, I know there's limited loss on these, but you have to sell 10 contracts and still paying 14%. And I'll just give you a quick comparison. Here's another one. It's a little bit better. It's a base rate of $9.99 per trade, and then a cost per option of $1.25, and this is with TD. And so they're substantially cheaper, especially when you're looking at these multi-legged contracts, like when we get up to the iron condors here and protective strategies, which is really where beginner investors should probably be looking, especially if they have small accounts. The problem with this column is you need large accounts. Say you want to sell one single contract of a strangle of SPY, then you need $6,000 of buying power just to put on that single contract. And for me, I would be paying 10% fee, basically on a $139 trade. I would be paying $12.49 to a brokerage. Now, just let me show you what Americans are now paying. So if the base rate is 0 and the contracts are 0.65 each, then on that same trade, $139, the fee to the brokerage is now $1.30 or 0.9% on any of these. So the maximum that I would be paying percentage-wise on a $1,000 trade, $52 would go to the brokerage, and I would make $1,000. So only 5% is going to the brokerage. So even these protective plays have become way, way cheaper just because of those changes to the fee structure. All right, enough about that. One of the questions I had was, how do I look at my stocks? And so here's my watch list. And you can see it's organized actually by the 52-week IVR, which is the IV rank. What I want is to be looking at stocks that are in the highest portion of their year volatility-wise, because I know that's when there's extra premium. So I don't typically open trades that are below a 30. So I can just resort this. And so we've got ANET, silver, GDX. So these are the precious metals, ACB, oil, Etsy. We just did a play on this the other day, made some money because it was at $55, and we just sold some naked puts, and just the stock went straight up as expected because it trades in a range. But when the volatility is high and there's lots of premium to be collected, it's pretty easy to do. So we sold when it was down here $55 just on Tuesday, and then closed that trade yesterday for a nice little gain, and could have even made more money had we held on to it today. But that's okay, we made our profit, it was great. XOP, Facebook, Square, and basically this is where I look through and I decide, like I often have a position in AMD. Now these are ones that I actually have positions open in, so what we're looking for is when the IV rank actually drops. So if we sell it when it's high, like Apple today is having a fantastic day, it's just completely going up, we can make a little adjustment if the IVR is still high. If the IVR drops down and it's still in the range, that's when we would look to close the trade and make some money off of it. So let's take a look at this SPY. First of all, we'll take a look at what I sold originally. So I think it was $1.38 when we did the video, and that was 2 weeks ago, and now we could buy it back. Over here, the bid ask on it is 50 cents or 45 cents. But I actually closed a portion of it out because when we look at the chart, what had happened, we sold the position when it was here, and it kind of went down, and then it kind of went up, and then it went way down here, and it actually broke through the 287 mark, which was the lower limit. That's the sold put. And as soon as it had done that, the call value, which is way up here, the 305, the stock was so far away from the call that it had no value left. I closed the calls for 4 cents. We had originally sold those calls for 61 cents. So that's how much we collected. And then I bought it back for 4 cents. So that's a pretty good profit on that, 57-cent profit. And I just left it open. I didn't sell anymore because I expected a bit of a rally because these stocks are so cyclical. So, and the market's so cyclical, and everything that's going on with Trump and China and everything. So down here, we closed the position, the call, and now we would make more money if the put went, or the stock went up, which it did. And it came up here, and then it came down a bit, and now it's rallying back up. And I've got the position still on, and it expires next week, October 18th. And going back to this other chart, looking at these ridiculous fees, I don't want to try to manage this at 50% because it's an iron condor. It just costs me a huge amount of money. So I want to hold to expiration so I can pay less in fees. So although it opens me up to different types of risk, maybe we're going to see a stock market drop next week, or, well, if it goes up, I'll just continue to make money. But if it drops, that's where the risk is at this point. So the position's actually adjusted, and the position that I own now, I would actually be able to buy out for 29 cents. That's the bid price on it right now. Which means that originally when we collected $1.15 per contract, and now I bought out part of it for 4 cents, and now if I could buy out the rest for 29 cents, then you can see the profits difference. It would be 33 cents to buy it out after we sold it for $1.15 originally. That's a pretty good profit. Now, because it's a iron condor, I opened more contracts on it. Because the iron condor actually limits the maximum loss and maximum gain, it reduces the buying power in my account. And because I have a large account, I can actually buy more positions. Now, the expected return on investment in this particular case, when we opened it, if we hold it to expiration, is 4%. And when we opened this, it was 21 days. So making 4% in 3 weeks, that's kind of the goal on this particular trade. So that is it. I hope that answers some questions. I know some of these videos are so complex. It's just, if you're a beginner option trader, it is difficult to understand, but it is so worthwhile to spend the time and learn how, especially now with these low rates, because if you continue to do this, you are eventually going to learn how to make money off the stock market when it goes down. And that is ultimately where we want to be, because a really good trader can make money when the stock market goes up or when the stock market goes down. Anyways, that's it for today. Thanks so much for watching, and let's get rich together.